Hello guys, so the market has finally fell. We are seeing small improvement in employment, but not that much of good news for the virus cases. Also in today's video, I will analyze last week's earnings report for Chewy, Adobe, and Lululemon since I gave you guys my expectations for them last week. What a week! We went from having the best month ever to having the worst week performance in 8 months. Last week, the S&P 500 was down 5% and the Dow Jones almost 6% for the whole week. First, we saw that huge uptrend in the stock market that happened within 2 weeks, recovering completely from its lowest points. We have to take into consideration that even though cases were decreasing every day and the economy was reopening, a lot of Americans used their stimulus check to invest or trade in the stock market, pumping it a little bit. All this was obviously the Fed pumping money into the economy and the stock market to avoid any major crisis during the pandemic. Also, after a huge drop in March, younger people like us saw the opportunity to start investing in the stock market, as well as other people gambling their money, looking for ways to double it within days. For example, people like David Portnoy, CEO and founder of Barstool Sports, which is a sport blog, switched from betting on sports, since sports were cancelled, to day trading in the stock market. And I'm very sure he's not the only one. Because of all this enthusiasm in people to enter the stock market, we have seen an increase in online brokers due to a spike in new accounts during the pandemic. All this led the media saying that this V-shaped recovery was led by retail investors like you and me and Robinhood, but not by the pros. If you ask me, I do not believe Robinhood has that many users to move the whole market, and still do not believe that us retail investors have that much power to influence a big uptrend like the one that we're currently in. In my opinion, the drop happened because of different reasons. First, the upticks in virus cases in different states that already reopened. This just reminded investors what me and so many people have been saying: we are not done with the virus yet. We do not have a cure or a vaccine, and going back to normal will take more time. Second, the bubble-like behavior in the stock market since May. All these companies are going up 30 to 70% within days, while the situation within those companies and the country has not changed at all. As well, investors realize that earnings in the foreseeable future for those companies will not be enough to justify the current market prices. Another reason is because of the Fed. Powell came up saying that recovery will take more time than expected, even though the stock market was not showing that. Also, they are expecting the unemployment rate to stay high, as well as to see a shrink in the GDP. They are expecting the GDP to shrink 6.5% this year, 2020, and then see an increase of 5% in 2021, and finally another gain of 3.5% in 2022. Another huge thing is that a lot of the Fed's members changed their mind about interest rates. Last year, majority of them wanted to already increase rates by 2021 to 2.5%, and then by 2022 to 3%. Nowadays, after everything that has happened, they all voted to keep rates near to zero until 2022, to give the possibility to businesses and people to borrow money for a very low cost and be able to sustain and come back even stronger after all this uncertainty during the virus. Take into consideration that this will obviously affect bank stocks, since it means that their revenue may actually decrease, since the majority of it comes from interest rates in loans, which is the reason why bank stocks are heavily discounted right now. I'm planning to do a video analyzing the 4 biggest bank stocks in the US next week, so stay tuned for it. Now, last week, IBM decided to abandon facial recognition technology to combat systematic racism because of everything that has happened with the police and George Floyd. Companies like Google have already stated that they were not going to sell their data for commercial use. Days later, Amazon and Microsoft decided to ban police use of this technology as well. They stated that the government should put in place stronger regulations to govern the ethical use of facial recognition and apply appropriate rules. During this week, we saw a lot of news about Grubhub, since there are a lot of companies trying to acquire it. First one was Uber. Grubhub and Uber were talking about a huge deal to merge, which would have brought the two of the largest food deliveries companies here in the US together. Days later, apparently an European company called Just Eat presented a dramatically better offer. According to Grubhub CEO, it was a much higher offer and more deal certainty that left them with more flexibility to continue doing what they're currently doing as a company. All these events led to a huge increase in Grubhub stock. Last week, I gave you guys my expectations for Chewy, Lululemon, and Adobe earnings report, and now let's go and analyze those earnings reports. First, Chewy, ticker symbol CHWY. They reported an increase in revenue as I expected from $1.1 billion to $1.62 billion in comparison with the last year's same quarter. That is a 46% increase in a year. It is not a secret that when all this pandemic started and people couldn't go out, Chewy became essential for pet parents to buy pet food. Their company is resilient to trends since their product is a necessity for people with or without a job. Also, we have to take into consideration that e-commerce is growing at a faster pace than expected, and this company is in a very well position for this increase. What I like the most about this company is that they got to where they are right now because of the trust and value they give to their customers. Also, we all have seen a huge increase in pet adoptions since the pandemic started. Between March and April, there was an increase of 60% in adoption in comparison to the same period last year, and that has made people engage more with their brand. Even though their balance sheet was not the best one last quarter, it has improved a little bit. Still, their cash and cash equivalents decreased 9%, but their ratios improved. Their current ratio went from 0.57 to 0.61, which still is very low in my opinion. Also, their total assets increased 20.5% and their total liabilities also increased 14%, which decreased their total debt to asset ratio from 1.4 to 1.3, which still is really high for this company. But they have a huge turnover ratio of 2.77 in 3 months in 2019, which would be 11 to 12 in a year, meaning that they sell and replace all their inventory 11 or 12 times per year. Next, Adobe Stock, ticker symbol ADBE. They reported an increase in revenue as I expected as well. It increased 14% from $2.7 billion to $3.1 billion. Their net income also increased by 74% in comparison with the same quarter last year, from $633 million to $1.1 billion. This company has been innovating tremendously year over year with their cloud. They offer engaging digital experience, which makes companies recognize that they have to partner with an entire ecosystem to have a good customer experience. As I mentioned before, they have been diversifying into digital marketing services as well. On their balance sheet, we can see that their cash and cash equivalents increased almost 15% since November 2019, and even though their short-term investments has decreased, their total current assets slightly increased by 2.3%. while their current liabilities significantly decreased by almost 37% from $8.1 billion to $5.1 billion by eliminating any short-term debt. This leaves us with an impressive increase in current ratio from 0.79 to 1.28, which, wow, they improved a lot, and it is more impressive than it was during the pandemic. Now, they have a total asset of $21 billion and total liabilities of $10.7 billion, which leaves us with an awesome total debt to asset ratio of 0.49, which is impressive. Last but not least, Lululemon, ticker symbol LULU or Lulu. As expected, because of the pandemic, their revenue decreased almost 17% from $782 million in May 2019 to $651 million. They also reported a huge decrease in net income of a whopping 70% from $96 million to $28.6 million. This means that their e-commerce or digital business was not enough to sustain and offset the losses from its stores being shut down due to the pandemic. Still, they saw a huge increase in market share, one of the largest one, due to people stocking up in workout and comfortable gear. Also, even though their sales in reopened locations are exceeding expectations, they do not expect to return to its earning growth until the fourth quarter. On their balance sheet, we can see that their cash and cash equivalents actually increased almost 43% year over year, but decreased 25% since February 2020 to $823 million. Lululemon reported total current assets of $1.69 billion and total current liabilities of $631 million, which leaves us with a current ratio of a whopping 2.68. Also reported total assets of $3.2 billion and total liabilities, which I calculated here for you guys, $1,365,999 billion. This leaves us with a total debt to asset ratio of 0.43. Basically, this company is loaded up in cash, able to convert into a debt-free company and still have a lot of cash left. I do recommend you guys go and watch this video where I give you my opinion on everything that's been happening with Nikola stock. If you enjoyed this video, consider subscribing and smashing the like button for the YouTube algorithm. Stay safe, stay home, thank you, and see you next time.